Welcome back to the Deep Dive. We take your complex research, all that dense stuff, and, well, we boil it down into real, actionable insights for you. Today, we're tackling something big in personal finance. It's this mental block, really, the idea that you need a pile of cash, thousands of dollars, just to even think about investing.
Yeah, and that's just not true anymore, is it?
Exactly. Our sources, they're clear. That myth is, well, it's dead here in 2025, starting out with just $100. It's totally possible. Actually, it's often recommended. So the mission for this deep dive is pretty straightforward. We're going to pull out the step-by-step, no-nonsense plan for taking that very first $100 and making it work for you.
And what's really interesting is looking at why this is possible now. I mean, compared to even 5, maybe 10 years ago, it's a different world. The research really points to three key things, 3 innovations that have basically opened up the market for everyone, making this $100 starting point a reality.
Okay, let's unpack this then. What are those 3 things? Walk us through them.
Okay, first up, zero commission brokers. This is huge. Basically, you don't pay a fee anymore just to buy or sell typical stocks or funds. And when you're starting with a small amount like $100, those fees used to just eat you alive.
Right, a $5 fee on $100 is,
Yeah,
that's a big hit.
exactly. Second is fractional shares. This one's a real game changer. Think about it. Historically, if a share of, say, Amazon cost $500, you needed $500, period. Now, you can buy just a piece of it. With your $100, you could buy maybe 0.2 shares.
So it's like buying a slice of pizza instead of the whole pie. You get the taste, the benefit, without needing the cash for the entire thing.
Precisely. And the third piece is these micro-investing apps. They're sophisticated tools, but they're designed to be super simple to use right on your phone. And often, the minimum amount to start is incredibly low, sometimes less than $1. So you put those 3 together, zero commissions, fractional shares, easy apps, and really the only barrier left is maybe just getting started, the psychology of it.
Okay, so if you're listening and you're ready to jump over that psychological hurdle, our step 1 is all about the foundation. It's not even about where to invest yet. It's about the why and the when. Clarifying your goal, nailing down your timeline.
That's absolutely right. The analysts we looked at really stressed this. Setting that foundation is critical because, frankly, it manages your risk. The big rule of thumb that came up again and again in the source material is only invest money you are sure, like really sure, you won't need for the next 3 to 5 years. If you think you might need the $100 next month for, I don't know, a car repair or something, investing probably isn't the right place for it yet.
Okay, that makes sense. And the goal you pick then kind of dictates the strategy for that $100, right? We pulled out 3 main goal pairings from the research.
Yeah, exactly. So first, if your goal is genuine long-term growth, think 5 years, 10 years, even longer, the overwhelming advice is to take that $100 and put it into broad stock ETFs or index funds. We'll get into what those are in a bit. Second, maybe your goal is more about learning the ropes, experimenting a little, seeing how things work with different companies. In that case, okay, you could buy individual stocks, but only using those fractional shares to keep your risk really small.
And this next one feels important. A bit of a warning almost.
It is. The sources are pretty direct here. If you step back and realize, hang on, I don't actually have any kind of safety net yet, then honestly, skip the market for now. If your real goal should be building an emergency fund first, then the best spot for that initial $100 is actually a high-yield savings account, not investing.
Okay, and speaking of safety, that brings us neatly to step 2. The sources had this really smart little tip. Setting up a tiny emergency buffer before you invest that full 100.
Yes, it's a clever move because you don't want some small unexpected expense of flat tire, whatever, to force you into panic selling that investment you just made, probably at a loss.
So how tiny are we talking for this buffer? Like $10?
The recommendation is pretty specific. Carve out maybe $25 or even up to $50 from that initial $100. Put that money into a high-yield savings account, or HYSA, first. This basically protects the money you do invest. It gives you that immediate cash cushion for little surprises.
And high-yield savings. What does that actually mean these days?
Right now, we're seeing providers like Ally, SoFi, Capital One 360 offering somewhere around 4.5% to 5% APY. That's the annual percentage yield. It's basically the interest you earn just for letting your money sit there. It's essentially risk-free growth, and it creates that mental comfort, that shield you mentioned.
Yeah, that mental shield.
Yeah.
Probably worth more than the actual $50 sometimes. Okay, so we've carved out our buffer. Let's say we have $75 left that we're ready to put to work. Now we hit that next question. Where do we actually do this? Step 3, picking the right beginner platform.
And this is crucial. Choosing a platform with zero fees. It's absolutely non-negotiable when you're starting with just $100. Like we said, even a tiny $5 trading fee just wipes out 5% of your capital instantly. Every single dollar you save on fees is a dollar that can grow, that can compound.
Makes sense. Okay, the sources highlighted a couple of main recommendations for beginners, plus a few others. Let's start with Fidelity. What's the deal there?
Fidelity comes up a lot as a top pick, and the reason is, well, it's probably the most robust option. It offers those free fractional shares we talked about, a huge range of investment choices, and basically no account fees or minimums to get started, like a $1 minimum. So if you're a beginner but you want a powerful platform you can kind of grow into over time, Fidelity is often seen as the go-to choice.
Okay, powerful, grow into it. Then there's Robinhood. They kind of blew up because their app was so simple,
Oh, yeah.
right?
Exactly. Robinhood is all about maximum simplicity. If what you really value is a super clean, easy-to-navigate app, maybe you're a bit intimidated by complex charts. Robinhood's great for that. And it has a $0 minimum. The trade-off, though, is generally fewer research tools, maybe less in-depth analysis compared to a bigger platform like Fidelity. So for you listening, it kind of boils down to preference. Simplicity with Robinhood or more features and power with Fidelity.
And what if someone wants something even more hands-off, like totally automated?
Yeah, for the set it and truly forget it crowd, there's Acorns. It gets recommended a lot for its roundups feature, where it rounds up your debit card purchases to the nearest dollar and invests the spare change automatically. It does have a $5 minimum to start, and there are small monthly fees depending on the plan. But for someone who maybe struggles to remember to invest manually, that automatic feature can be really appealing.
Okay, now wait a minute. Our source material definitely mentioned Vanguard. They're famous for their low-cost funds. But I always thought Vanguard needed, like, thousands of dollars to open an account. How does our $100 investor get access to Vanguard goodness?
That's a really good question and a common point of confusion. Those high minimums, sometimes $1,000, even $3,000, usually apply only if you want to buy Vanguard's own mutual funds directly from them. But here's the key. You can still buy Vanguard's excellent low-cost exchange-traded funds, their ETFs, through those zero-fee brokers we just talked about, like Fidelity or Robinhood.
So you use Fidelity to buy a Vanguard ETF. You get the Vanguard fund without needing the big Vanguard minimum.
Exactly. It connects right back to those enabling innovations. You get the quality fund through the accessible platform.
Nice workaround.
Yeah.
And speaking of getting a little extra boost, the research mentions some fun stuff too. Bonus perks for signing up.
Yeah, these are basically little welcome gifts for new investors. Robinhood, for instance, often gives you a free stock. Could be worth $5, could be $200. It's random, just for depositing $10 or more. Webull sometimes gives away like 10 or 20 free fractional shares. Public might give you a free slice of a popular stock just for opening an account. It's not life-changing money, obviously, but hey, it's a nice little way to bump up that initial $100 without spending extra. Worth checking out what offers are current when you sign up.
Okay, cool. So accounts open, $100 in there, maybe $75 after the buffer, and maybe we even snagged a free $10 stock slice. Now we get to the core. Step 4, investing that money wisely. I think the fear here for a lot of people is that $100 feels so small. Like you have to hit a home run with it, right? But the data says, actually, no, we need to play it safe.
Absolutely. You've hit the nail on the head. The overwhelming consensus advice for a beginner's very first $100 is option A. Put 100% into a broad ETF. This is hands down the safest, simplest path for long-term growth. Remember, an ETF, an exchange-traded fund, is basically like a basket holding hundreds, sometimes thousands of different stocks all bundled together. You buy one thing, one ticker symbol, but you get exposure to everything inside.
Why is that better than just picking, say, one stock I like, maybe Tesla or Apple?
Diversification. If you put your whole $100 into Apple and Apple has a rough year, well, your whole investment suffers. But if you buy a broad market ETF, you instantly own a tiny sliver of hundreds of different companies. If one company stumbles, the other 499 in the basket can help balance things out. It's instant diversification, and that's how you manage risk, especially when you're starting small.
Okay, instant diversification. Got it. So what specific ETFs did the sources recommend for this strategy?
The recommendations really zeroed in on funds with incredibly low expense ratios. That's the tiny annual fee the fund manager charges shown as a percentage of your investment. We're talking minuscule amounts, like 0.03%.
Wait, hold on. 0.03%. So if I invest $100, that's like 3 cents a year in fees.
Exactly. It's basically free. And that's why it's so critical when you're starting small, you're not losing your potential gains to fees. The top 3 that kept coming up were VOO, which is the Vanguard S&P 500 ETF. It tracks the 500 largest companies in the U.S. Think Apple, Microsoft, Google, the big names. Then there's VTI, the Vanguard Total Stock Market ETF. This one's even broader. It tracks pretty much the entire U.S. stock market, thousands of companies, big and small. And SCHB, which is the Schwab U.S. Broad Market ETF. It's very similar to VTI, also tracking the whole U.S. market, also with that super low 0.03% expense ratio.
Okay, VOO versus VTI. Let's clarify that difference because it seems subtle, but maybe important. VOO is the top 500, VTI is everything. What does that mean practically for someone starting out?
Yeah, good question. VOO gives you more concentrated exposure to those really big established market leaders, the household names. VTI is much broader. It includes small cap and mid cap stocks alongside the large ones. So VTI gives you slightly deeper diversification across the whole US economy. It might be considered marginally safer just because it's spread wider. Honestly, for beginners first $100, either VOO or VTI is an excellent choice. You probably can't go wrong. Maybe VTI edges it out slightly for maximum diversification.
And this brings us back to those fractional shares again. Let's say VOO is trading at, I don't know, $500 a share right now, and I only have my $100 or my $75. Is buying just a fraction really worth it? Does it even work?
It absolutely is worth it, and yes, it works perfectly. That's the magic of the zero commission fractional share system. Your $100 buys you, in that example, roughly 0.2 shares of VOO, and you get all the benefits proportionally. If VOO goes up 1%, your 0.2 shares go up 1%. If it pays a dividend, you get 0.2 shares worth of that dividend. This small technical detail is what makes investing $100 totally viable and effective for the long term. It's not just symbolic money anymore.
That really clicks now. Okay, so option A is the simple, safe 100% into VOO or VTI. But what if someone hears diversification and wants to, actually do it themselves, even with just $100? Learn the process. Our sources mentioned in option B, right? The diversified micro portfolio.
Yeah, this is a great option for someone who's maybe a bit more curious, wants to get their hands dirty with asset allocation right from the start. It outlines a simple 70-20-10 split for that initial $100.
Okay, break that down for us. 70-20-10 of what?
So you put 70%, that's $70 of your $100 into your core U.S. market holding. So again, that's your VOO or your VTI. That's the engine of your growth. Then you allocate 20%, $20, into something like VXUS. That's a Vanguard Total International Stock ETF. Gives you exposure to companies outside the US, across Europe, Asia, etc. This adds global diversification, helps protect you if the US market hits a slump. And finally, the last 10%, $10, goes into something like BND. That's a Vanguard Total Bond Market ETF. Bonds are generally less volatile than stocks, so adding a small slice provides a bit of stability, kind of like a shock absorber for the portfolio.
Wow. Okay, so for $100, you can actually build a mini portfolio with U.S. stocks, international stocks, and bonds. That's surprisingly sophisticated.
It really is. Thanks to those low cost and fractional shares, it lets you practice diversification principles from day one.
But, and this feels like the most important part maybe, investing the first $100 is just the start, isn't it? It's what comes next. Step 5 in our research, this is where the real magic happens, right? Consistency, automation, dollar cost averaging.
Unanimous agreement on this in the sources. Consistency is your actual superpower here, not the initial amount. The key action step is to set up small, regular, automatic investments, even just $10 a week or maybe $25 a week if you can manage it. This process has a name: dollar cost averaging. By investing the same small amount regularly, whether the market is up or down, you naturally buy more shares when prices are low and fewer shares when prices are high. It averages out your purchase price over time. And crucially, it takes the emotion and guesswork out of it. You're not trying to time the market perfectly, which is basically impossible anyway. You just keep feeding the machine.
And setting up that, say, $10 a week auto invest. The source pointed out is two things right away. First, it just mathematically turns your initial $100 into over $500 in the first year, just from those added contributions. 10 weeks, 52 weeks equals $500. And second, it builds a habit.
That habit is everything.
And the power of that habit, plus time, he's kind of mind-blowing. The source material had this really stark example using compounding. If we look at the S&P 500's historical average return, about 7% per year after inflation. Just watch what happens to this single initial $100 investment if you never add another penny, but just let it grow. So you invest $100 today. By 2030, assuming that average return, it's maybe around $140. Not huge yet, but wait. By 2040, it roughly doubles again to $280. And by 2050, it doubles again to about $560.
That's the power of compounding, that exponential curve. It shows that the amount you start with matters way, way less than how long you stay invested and how consistently you contribute, even small amounts. Time in the market beats timing the market every time.
Which leads perfectly into the final step, step 6. This is about protecting those potential long-term gains by, well, not messing things up early on, avoiding the common pitfalls for $100 investors.
Yes, some crucial warnings here for beginners.
What are the biggest traps we need to sidestep?
Okay, number one, and this came up repeatedly. Don't try to day trade meme stocks. Seriously.
Ye-
When you only have $100, the insane volatility of those stocks, plus the temptation to maybe use leverage you don't understand, one bad bet, one bad day, and your entire starting capital can just vanish. Poof. You simply don't have the financial cushion to absorb those kinds of wild swings. The sources basically scream, this is the fastest way to turn your $100 investment dream into a $100 expensive lesson.
Okay, steer clear of the meme stock frenzy. What about crypto? That gets hyped as a way to turn small amounts into big money fast.
Yeah, that's the second warning. Don't put 100% of your initial funds into crypto. Look, maybe later on when you have a larger, more diversified portfolio, allocating a very small speculative percentage to crypto might be something you consider if you understand the risks. But using your entire starting $100 in something so notoriously volatile, it's just too risky for your foundational investment. Remember, the goal here is long-term, steady growth for this first step, not a lottery ticket.
Right, foundation first. And the third pitfall brings us back to something we touched on earlier.
Fees.
Pitfall number 3, avoid high-fee mutual funds. We talked about those ultra-low 0.03% expense ratios on ETFs like VOO and VPI. Some actively managed mutual funds can charge 1%, 1.5%, even 2% or more per year. When you're starting with just $100, those higher fees will absolutely devour any small gains you make. It's like trying to fill a leaky bucket. So always check that expense ratio before you buy anything. Stick with the cheap, broad market ETFs.
Okay, that makes total sense. So let's boil this whole deep dive down. What does this all mean for you, the listener? Ready to start with $100. Here's the TLDR, the quick action plan straight from the research. 1. Open a zero-fee brokerage account. Fidelity if you want features, Robinhood if you want dead simple. 2. Deposit your $100, but remember to maybe slide $25 or $50 into that high-yield savings buffer first. 3. Buy $100 for the remaining amount of VOO or VTI using fractional shares. Boom, instant diversification. 4. Set up that automatic investment. Even just $10 a week makes a huge difference. Commit to it. And 5, this might be the hardest part. Just ignore it. Let time and compounding do their thing. Don't check it every day. Give it 5 years minimum, preferably much longer.
It really is that straightforward, the core takeaway, the pro tip from the sources. Treat that initial $100 investment like planting a seed. You put it in good soil, the low-cost ETF. You water it regularly, the auto investments, and then you step back and let it grow over seasons and years. Your biggest advantage as a beginner isn't having a lot of money, it's having a lot of time.
Yeah, that's powerful.
And ultimately, what the market rewards above all else is that consistency. So this deep dive, it wasn't just about the $100, was it? It's really about building a powerful financial habit. Investing that first $100, automating the $10 a week, it's a perfect low-stakes exercise in delayed gratification and consistent effort. Which, makes you think. Here's a final thought to chew on. What other small, automated, consistent habit could you start today, maybe not even financial, that could offer a really high long-term return on your time or effort? Think about it. Just like dollar cost averaging builds wealth slowly but surely, what else could you build with that same principle? Start small, stay consistent, but the key is to start now.